Welcome to The Preferred Return, Skadden's investment management podcast covering legal and regulatory developments in the UK and Europe.
I'm Greg Norman, and I'm here with my co-host, Abby Reeves.
The Preferred Return is a Skadden podcast series providing short summaries of legal, regulatory, or other topical developments in the UK and European investment management space.
Our podcasts are intended to be accessible by professionals across the sector. We welcome any feedback, particularly if there are topics people would like us to discuss. Today, we're going to try and tackle the AIFMD, and in particular, some of the upcoming updates to that legislation.
We thought we should start off with a brief summary of what the AIFMD is. The Alternative Investment Fund Managers Directive is an EU legal act which formed the basis for a harmonised framework for the management and distribution of alternative investment funds, or AIFs, in the EU. The AIFMD came into force on the 1st of July 2011 and was required to be implemented in EU member states' national legislation by the 22nd of July 2013, and so has been in effect for over 10 years now. The regime imposes a number of requirements on alternative investment fund managers, or AIFMs. AIFMs are legal persons whose regular business is to manage one or more AIFs, and AIFs are a type of collective investment vehicle which raise and pool capital from a number of investors with a view to investing it in accordance with a defined investment policy for the benefit of those investors. Broadly speaking, an AIF captures any fund that is not a UCITS fund.
Thanks, Abby. Following the introduction of the AIFMD, any person carrying out the business of an AIFM in an EU member state was required to be authorised and regulated by the regulator in that member state. For example, the FCA in the UK, the AMF in France, or BaFin in Germany. Regulated AIFMs are subject to a range of governance and regulatory standards that also impact how they manage and operate their AIFs, such as by introducing increased reporting obligations, disclosure obligations regarding side letter provisions, and for AIFs acquiring EU or UK companies, asset stripping rules. At the House level, the AIFMD introduced remuneration rules, as well as restricting the ability of the AIFM to delegate certain functions and enshrining certain liability standards. So, Abby, where are we now?
As with most EU financial regulation, the AIFMD has been subject to review and update throughout its lifetime. There have been small updates via regulation, such as the introduction of the pre-marketing regime, which we discussed in a prior podcast. However, in April 2024, an amended version of the AIFMD came into force, which we'll refer to as AIFMD2. EU member states will now have 2 years to transpose the rules into national law, meaning that AIFMD2 should apply across the EU from the 16th of April 2026. Since these rules were passed after the UK's exit from the European Union, the rules will not change the UK's implementation of the AIFMD, although it remains to be seen whether the FCA or the UK government will make any aligning updates in any event. AIFMD2 represents the most significant update to the AIFMD to date, and will have a material impact on a number of important sectors of the private fund market. To understand these changes, Greg, can you give listeners a bit more background on the original drivers of the AIFMD?
Very happy to. The AIFMD was introduced, at least in part, in reaction to the financial crisis and the growing importance of the alternative fund sector on financial markets. EU regulators wanted to improve supervisory practices in relation to alternative funds, with the end goal of increasing market stability and reducing systemic risk. They also wanted to increase the protection afforded to investors and to level the playing field across the EU by introducing harmonised standards. The EU had looked at the success of the UCITS regime, which is the legislation which covers the majority of retail investor-facing funds across Europe. It sought to track that regime across to the alternative sector. The results included the introduction of a depository regime, which imposed standards on custodians to be responsible for monitoring investment activity, as well as imposing fairly high investor disclosure rules and reporting requirements to increase transparency. The alternative investment fund market is extremely broad, and the AIFMD was seeking to regulate all asset classes, whether that be hedge funds, private equity funds, real assets funds, or the most recent growth class, private credit funds. Perhaps unsurprisingly, a catch-all approach has not been entirely successful, nor did it anticipate the potential growth and development of the fast-moving private capital space.
And that helps explain the focus of AIFMD2, which the EU hopes will enhance the regime. The changes include increased disclosure obligations, both investor-facing and to regulators, additional obligations on AIFMs which delegate key functions, as well as specific rules for certain private credit funds. Looking first at the investor-facing disclosure obligations, Investor disclosures are required by Article 23 of the AIFMD, and this captures the information which all AIFMs must provide to potential investors before they invest. These provisions have been updated with a particular focus on fee disclosures and, for open-ended funds, any liquidity management tools which have been put in place. AIFMs will also have more extended reporting obligations to regulators through Annex 4 reporting. Annex 4 reports will now have to include detail on which member states an AIF is marketed to, the total amount of leverage employed, and a number of details regarding delegation arrangements.
To pick up on that last point, delegation has been a key area of focus for EU regulators, and it was a point of significant contention during the negotiation process of the AIFMD too. Under the AIFMD, portfolio management and risk management are stated to be an AIFM's key functions. While an AIFM is permitted to delegate many of its ancillary functions, it may only delegate one of portfolio management and risk management. This arrangement is similar to the delegation model under UCITS, and it gave rise to the very popular third-party AIFM model. Given the cost and complexity of establishing a regulated AIFM, a number of fund managers, particularly those outside of the EU, entered into third-party arrangements with EU-regulated AIFMs who would serve as the AIFM of the fund while the fund manager acted as the portfolio manager. For non-EU fund managers, this presented a very efficient way of operating an EU fund and accessing investors across the EU. EU regulators were wary of the potential to abuse this provision, which is why the AIFMD includes the so-called letterbox provision, where an AIFM must fulfill one of these functions properly and, as stated in the legislation, not simply act as a letterbox. Third-party AIFMs, who typically retain responsibility for risk management, must therefore ensure they have proper processes and resources in place to carry out that function.
Thanks, Greg. Despite the existing rules, there was a concern amongst EU rulemakers that the delegation rules were not operating properly and that delegation arrangements were not subject to sufficient oversight by home state regulators. In the development stages, the changes considered by the EU were varied and at one point included a ban on delegation of either core function. However, AIFMD2 ultimately settled on increased disclosure requirements. This means that any AIFM wishing to delegate its core functions or its ancillary functions, such as fund administration, marketing, or fiduciary services, must make disclosures to its home state regulator of the delegation and must be able to demonstrate that the delegate is capable of performing the tasks delegated to it. We anticipate that this will have an impact on third-party AIFM arrangements, given the increased scrutiny such firms will have to have on their delegates.
Another area to keep an eye on is the new loan origination fund rules, which will impact any private credit funds which originate loans and where originated loans make up or are expected to make up at least 50% of the NAV of the fund. These rules will apply to any AIFs managed from the EU, but there will be no distinction between EU and non-EU borrowers. The regime introduces a number of requirements specifically targeting these funds, including a risk retention requirement, which is very similar to those rules applying under the securitization regulation. There is also a concentration limit of 20% of the fund's capital, governance and risk management requirements, leverage limits, and a requirement for such funds to be closed-ended, amongst some other requirements and obligations. While a number of these rules will codify what is already market practice for many private credit funds,